This week, the firm reports from on location the 68th Congress of the International Fiscal Association. 1,000 tax professionals in Mumbai debating tax morality, double non-taxation, base erosion, profit shifting, digital economy taxation and treaty abuse. As the global economy is awash with tax challenges, the firm focused on revenue reform. What are countries doing to stake claim to their fair share of taxes? Inversions are the most recent example. Several American corporate giants like Pfizer, Walgreens, Medtronic and Burger King have contemplated overseas mergers and hence reincorporation in a more beneficial tax regime. But last month, the US Treasury Department announced a new set of rules to make inversions less viable. These include closing a loophole that allowed a tax-free transfer of cash or property from a foreign subsidiary to the new foreign parent. Perhaps owing to the new rules, this week, US-based pharma company AbbVie called off its $54 billion takeover of Britain's Shire.
I think what that does is lets the air out of the balloon, and therefore you're less likely to see, certainly the big rush to the door that we have seen is going to go away.
If in self-interest people want to reduce their effective tax rates, and the corporate income tax in the United States isn't that big a revenue raiser compared to our total fiscal raise, what are we really saying? We're saying U.S. companies should pay higher taxes or have higher thresholds and burdens than foreign companies otherwise equally situated, and that's just not fair.
In its chase for its fair share of taxes, US has also put pressure on Ireland, and the double Irish sandwich is no longer on the tax avoidance menu. The infamous structure typically involved the use of two companies in Ireland, one of which is a tax resident in a tax haven. Several multinationals like Apple and Google have been accused of using the Irish sandwich to shift profits from high tax countries to no tax countries. But starting January, all Irish domiciled firms will have to be tax residents there.
If they're now saying that incorporated companies in Ireland will be Irish resident, which is what the UK did in 1988. The UK made exactly the same change 25 years ago, and which many other countries, Australia is one, uses incorporation or management as the test of residence. That will certainly make it much harder to run the kinds of structures that we've seen with a lot of publicity in recent years.
Meanwhile, Australia is battling with intangibles, and there's no tangible solution in sight. The high-profile case keenly awaiting a court verdict is Chevron, where the Australian Tax Department has alleged that the oil giant used structures to gain tax-free interest on intercompany loans. In Chevron's case, the intangible under scrutiny is the interest payments. Experts say such transactions can take place in other forms too.
This is just a manifestation. So the discussion about interest, what price should the local subsidiary pay on money that it borrows? You could ask that question about any other transaction that the local subsidiary conducts with its parent. If it's paying a royalty to its parent, what rate should that royalty be set at? If it's paying some kind of license fee.
While countries rewrite tax laws, the OECD is working on a base erosion and profit shifting action plan to assist countries to claim their fair share of taxes. Last month, the OECD released its first action plan to deal with tax challenges in digital economy, treaty abuse, transfer pricing, hybrid mismatch arrangements, etc.
Not only for governments, but also, and I think this is kind of the indirect consequence of BEPS, trying to tell taxpayers that the rules of the game are now changing. The environment that you thought you were living in, that's yesterday. In the 21st century, some of the things that you thought were okay will not be okay. And that may be the lasting legacy of BEPS, that taxpayers will be a little less ambitious, a little less pushing at the boundaries.
The many trillion-dollar question is this: the impact on how multinational corporations do business across the world. Well, on this very special episode of The Firm, on location, the 60th Congress of the International Fiscal Association, I'm joined by 4 of the best tax experts from across the 1,000 tax experts that are delegates here at this event. I'd like to introduce Porus Kaka, the president of IFA, Michael Lennard, the chief of International Tax Cooperation at the UN, Philip Baker, a very well-renowned QC, and Pramila Shrivastav, former Chief Income Tax Commissioner, a former IRS officer as well. Gentlemen, and Pramila, a warm welcome to all 4 of you to this special episode of The Firm. I'd like to start first with you, Michael, if we can. If you could lay out for us, because you see both sides of this debate take place, what you think are some of the top challenges that face both revenue as well as, therefore, taxpayers across the world.
A lot of our countries, even knowing their taxpayers is an issue. But we generally look at there's informational gaps, which is very important for developing countries. There's resource gaps. Even if they do get information, they can't process it in the way that they want to. And there's legislative gaps where it's very hard for them to have legislation that works.
I think you need to make a distinction between small and medium-sized enterprises, which are the greatest number and very often the major employment creators. And for those enterprises, the biggest problem, I suspect, is the simple compliance cost. It's a question of certainty, but it's simply the compliance cost. Your question, though, I think primarily asks about the relatively small number of multinationals that dominate international trade, and what are the issues that are going to affect them over the next couple of years. And you asked for 5 areas. Well, the BEPS project through the OECD, base erosion and profit shifting, is dominating the work as it relates to multinationals, and there will be a whole series of changes that come out from those. Some of them potentially problematic. For example, country-by-country reporting is something where no one yet quite knows what impact that's going to have. The aim is that it will be simply a way of identifying potential issues, but there's a fear that it will actually open the door for governments and multinationals to start challenging the amount of tax paid by companies in particular jurisdictions. Treaty abuse or the introduction of anti-treaty abuse measures into tax treaties are going to raise questions on existing structures. On the positive side, one of the elements that's promised from BEPS is an improvement in the resolution of tax disputes. That's a big issue for multinationals and I think for medium-sized enterprises as well. Generally, the whole area of transfer pricing is very active, and a number of elements of the BEPS project relating to intangibles, relating to documentation are likely to make changes. But I'll pick up a 5th matter which links the Congress here in Mumbai with the Congress next year in Basel, and that's the question of the practical protection of taxpayers' rights. Because as one increases the powers given to revenue authorities, it's key that one balances that with effective and practical protection.
What's definitely going to happen, and I believe that's going to be a game changer, is exchange of information. I think there is a level of seriousness even at the political level and a level of commitment at most of the major economies. You know the economies that are slightly not committed, you're aware of them, but the major economies, even the United States, the developing world, I think there's a seriousness of that, and that's where Philip mentioned the country-by-country reporting. That amount of information, you must remember, information is key today. That amount of information could be good, it could be detrimental. I mean, how to process that information that the revenue authorities across the world are going to get is going to be a huge challenge and a huge concern for all taxpayers. So that's definitely going to happen. The next thing that's going to possibly happen is we're going to get some kind of a multilateral treaty along the way, some draft in the next couple of years. Now, yes, that's going to be the simplest way of changing all the current treaties. But my concern is that that is going to possibly have either very few signatories or many signatories with protocols, annexures, riders, savings clauses. So the effectiveness of that I would just leave for debate at present. I don't know how that's going to happen. Last two I think is really the digital economy, which I think is going to grow leaps and bounds, and how the world deals with that, and that ties in with this wonderful concept that we saw in the very first draft of the OECD report, which talks about value creation. That word nobody knows. Everybody in each government or each country knows what it wants, but nobody really knows what it means. Whether it means market, it means activities, it means source of payments. I think there are huge issues on that. That ties up with transfer pricing, that ties up with really the allocation of the right to tax and the attribution of that right, and consensus on that, I would say, is going to be extremely difficult.
How prepared, Pramila, is Indian revenue to deal with all of these challenges?
See, I strongly protest against the word fair share of taxes, because fair and tax are oxymoron.
Okay.
They don't go together. Nobody likes to pay taxes. Having said that, I would imagine that the Indian Revenue Department, from what I know, and let me clear it that I am not representing the department anymore.
We understand that. Yeah.
So these are my personal views.
I get that.
I think they are struggling with a constant stage of change management. So many things are happening that it is not the taxpayers and the new companies alone, but the Department of Revenue itself is also constantly facing challenges that are coming with the change in the system of governance and trade and business. I mean, permanent establishment as I used to know 10 years back is no longer valid. You have e-commerce coming in, you don't have a clue how to tax it. It will be interesting to know, very helpfully, I read in the papers, day before yesterday Vodafone suggested to Income Tax Department that why don't you tax Facebook and WhatsApp also. So, it is almost like a big jamboree of taxpayers of different levels of expertise, different business, and I think the Revenue Department does not, I mean, it is not backing off from what it has to face.
Oh, definitely not.
But reality, but the reality is that you learn from experience.
Okay.
Like especially in transfer pricing, for example, that is a very, very common complaint, that it is very aggressive transfer pricing decisions taken by the government. But the truth is that we are still learning through our way.
Okay. So, you all have laid out for me what the current context is. I want you to look a little bit into the future and talk about, I think, what seems to be here the first very key issue, and it links into what Porus said about value creation as well. Who is your taxpayer, which is becoming a more and more difficult thing to reckon in this sort of world of digital commerce. Where is that value being created? Where should that revenue necessarily be taxed?
Yeah, it is a huge issue, and when you look at the BEPS action plan, it's not even just value creation. It says where economic activity occurs and value is created. So you even have the issue of, well, what if the two are disconnected? And I think that the digital economy is a good example of that. You also see it in the discussion in the UN Practical Manual on transfer pricing, where China and India, and even in fact South Africa, talk about location-specific advantages. And I think that really shows that a lot of developing countries are more focused on, particularly the larger ones, on the market side of value creation, whereas traditional approaches to transfer pricing have focused more on the production side. So clearly I think one of the bigger developments will be to recognise more that market end approach.
Can I jump in and try and shift the focus a little here, because what you're focusing on is the determination of the profit attributable to companies, to countries, from a relatively small number of multinationals and the imposition of corporate profit tax. That is typically in most countries one of the relatively minor taxes that yields only a small part of the total tax revenue. In most of the developed world, corporate profit taxes yield less than 10% of total tax revenue. In developing countries, sometimes it's more. It can go up as far as into the 20%, but I don't know of any country that it goes above 25%. There are a whole range of other taxes, customs duties, indirect taxes, taxes on land, that yield for many countries the larger part of the tax revenue. And looking at it from the point of view of India, one of the most significant changes that will have taken place in 150 years of the Indian tax system will be the introduction of a union-level goods and services tax. You're one of the two major countries in the world that doesn't have a federal level goods and services or VAT, and that's going to be a game changer. What has changed in the last 50 or 60 years is an increased expectation from the population for public goods, for education, for health, for other services, and people recognize that they do have to pay for that by taxes. But given that people expect this of governments, governments have to tap into every source that they can to raise revenue. And countries that don't introduce goods and services taxes or VATs are in a sense condemned to try to squeeze out of the other taxpayers through a profit tax as much as they can. And that's where you get into problems of disputes and problems of transfer pricing.
Pramila, exchange of information, change in treaties across the world. Is revenue getting more empowered to be able to go after what they think is their fair share of tax, whether it lies overseas, or otherwise?
I would imagine it would. I mean, that doesn't mean to say that there isn't any debugging to be done. There are major issues on which India differs from other countries,
For
and
instance?
that would,
For instance?
if I'm not mistaken, that issue of sovereignty on arbitration remains.
Just to answer her question, and Philip may also agree with me on this, I was surprised to see a collection of taxes article in the latest Indo-UK protocol. I never thought that would happen that fast, especially with UK, but it did happen. So we have a protocol which now has an article which allows the Indian revenue to collect taxes which are lying in, if someone's not paid and he's based in United Kingdom.
I gave the UK negotiators quite a bit of stick for that. I think they should never have agreed to that. But I was going to take up Pramila's comment about sovereignty, because there's an interesting balance here. It's strange that, again going back to BEPS, some of the proposals are to limit the scope of action by governments. For example, requiring governments to put in anti-treaty shopping provisions in their treaties, or governments to adopt arbitration of tax disputes. And you might well say, oh, well, by limiting the action of governments, you're taking away their sovereignty. But the argument of the OECD, and I think I buy into this, is that actually you are preserving government's sovereignty by limiting it, in a sense, there, because governments are facing very strong multinationals that you want to get into the country. They're facing strong international pressures. They're facing competition from other countries. If you don't limit your scope of action, you will find that business is driven away. And I think arbitration is a matter upon which I solemnly hope that India recognizes that it's an act of sovereignty to agree to arbitration, even though at the end of the day the arbitral result is something over which you no longer have control, and therefore might be seen as a loss of sovereignty. But you've chosen to go into that. Why have you gone into that? Because other countries and investors demand a fair system of resolving disputes, and that must involve something like arbitration.
A lot of these changes that you gentlemen and Pramila have flagged off, are they going to happen as uniformly as one expects over the next 5 years? Or is this going to be a multi-speed set of reforms that will take place across tax policies across the world?
It's very difficult to answer that because, again, it goes back to the leadership being shown by the G20 and by the OECD and by the UN, much of which is aimed at trying to ensure that we don't end up with lots and lots of unilateral action by governments, but that there is coordinated action, because, again, if I can refer back to what I said before, by governments acting together, they preserve their sovereignty rather than losing it. I fear, though, that we will actually see the contrary, and we will see governments acting unilaterally and independently with their own versions of their own solutions, because each of them is under their own pressure. In some sense, it's actually really quite surprising that we have had 50, 60 years of commonality in the approach to international taxation through the work, I suppose probably more than 50, 60, maybe 100 years, through the work originally through the League of Nations and then through the OECD. The problem now is that the OECD represents of itself only a small fraction of countries, and the UN doesn't yet have sufficient resources and isn't sufficiently set up to provide world leadership on international taxation.
If you had to sort of leave us with one thought on what you think the biggest change will be for Indian taxpayers, assessees, mostly corporations, because that's our audience, over the next few years, what would it be?
Definitely the one single only solution, in my opinion, is a better tax administration. We have enough policies around.
Developing standards for the practical protection of taxpayers' rights. That's something that we've got to focus on, and it's not just India, it's all countries across the board, and it's all taxes, and it goes way beyond BEPS, because we're giving revenue authorities massive powers, and we need to balance them. And just to give one example, the huge amount of automatic exchange of information will give to revenue authorities tremendous information about the personal details, the addresses, the dates of birth, the wealth of particular individuals. If I were minded to join a mafia-like organization, I think I'd be trying to put my plants into revenue authorities around the world to tap into that information to identify for the future who are going to be the good targets for whatever it might be, or kidnapping, whatever. And nobody is thinking in that way about the safeguards that we need. So standard setting, practical protection of taxpayer rights, that's critical.
Well, I think I would agree with Philip, but I see exchange of information as going to be the game changer that's going to come in the next few years. Whether it's the obligations that you have to report or the data that the tax authorities can get, the safety of it is one aspect. Philip is absolutely right. But I think just the ability to use it, to process it, and it's available to all authorities across, it's going to be a huge game changer.